In this video we're going to go through covered calls, what they are, how to use them and how to estimate your potential profit. So firstly, what are covered calls? And all covered calls are is selling a call on a stock where you own 100 shares of. So if you own 100 shares of Tesla, you can sell a covered call above the price that you bought it. You receive income from selling that option. So it means if the price decreases from where it currently is or from when you bought in, you can limit your downsides. But it does have its drawback. If it goes above the strike that you sold at, you do miss out on potential gains, but we'll get through that all in this video. So to get straight into it, we're going to do this example on Tesla, and we can see it's currently sitting at $290. So to make this example very clear and simple, we will do everything on the whole dollar. So I have made an Excel sheet for this to make it even more clear and so you can see it visually to make everything simple. So Tesla, currently $290 a share. So this means if we were to buy 100 shares, we would have to spend $29,000. Now do note, don't let that scare you. You don't have to do it on stocks of this value. You could do it on a stock, say, such as Rite Aid, where the shares are like 6 to 7, I think actually as of right now, $8. So if you were to do it, you would only spend $800 to acquire all 100 shares. So you can do it on lower price stocks if you don't want to be spending, say, $29,000 to buy 100 shares. Now, it's going to cost us $29,000 to buy all 100 shares. Now, how much do we receive for selling this call? So this price will always differ, but all you need to do, and in this example, we're going to be using Tastyworks because this is where I do all my options. I may do charting on Thinkorswim, but Tastyworks is better for executing option strategy. So if you want to join and you haven't already joined Tastyworks, check the first link in the description. But going short, and then we need to go over to option, and make sure you selected call. And then once we've done that, this is now going to short a call for us. So you can really sell these near enough at any strike, usually on the whole dollar. And over here is your expiry. Usually we will aim to do an expiry less, or 60 days or less, because if you understand time decay and in options, all that means is the option loses value the less time it has left. And as we're selling it, we want to profit from this time decay. So really, we ideally want to be selling the call from 60 days expiry or less. So in this example, we will go to kind of say 56 days, so less than 60 days, but pushing it a bit. So in this example then, 56 days to expiry. And if we were to sell, we could say a $300 strike. I think that's quite a good amount. In this example, then we would make $2,150 for selling this $300 call. So let's go back to the Excel and now add in the 2,100, and to make it even clearer, we will just do 50. So $2,150 we would make from this call. So this clearly shows us then right away that just for selling this call, we make 7.4% back instantly from what we invested. So this means then the share could fall 7.4% and we would now be at break even. And this is what this part tells us down here. So we pay $290 per share on Tesla, and now because we received $2,150, our new break even is $268.50. So it means, yeah, the stock can fall 7.5% and now you'll be at break even. So what this also means is come expiry of this option, it's below $300, so we keep all 100 shares of Tesla. We would have made 7.4%, or if the stock fell, maybe a bit less than that, but around 7.4% for really just holding this stock for 60 days, even if it hasn't increased in price. So that's one way, again, you can offset risk because it lowers your basically lowers your average price. Now, what else do we need to see? So we are currently, we bought the shares at $290. Our our strike is at $300. So the difference between buying it and the strike is $10. So this would mean we make $10 a share on 100 shares. This would make us this $1,000. So now you can see everything else here has now been filled in. So what this means is if Tesla closes at $300 come expiry, we would make 10.9%. Now if Tesla closes at $400 come expiry, we still make 10.9%, because that is now the maximum we can make on this trade. So as long as Tesla, if Tesla is below $321.50, this trade was optimal. Selling the covered call was a good choice. However, if Tesla goes to say $340 in that 60 days, then you would have been better off not taking the trade. However, obviously you're not going to know that until expiry, but it's usually just good to be able to see where would it have been better, where would it not have been. But really that would require Tesla to move 10% from where it is now. But we are really already locking in 7.4%, even if Tesla stays where it is. So you're kind of sacrificing that 3%, but you get your profit. Well, you get your profit now and you're kind of guaranteeing it, and you've also made yourself less risk exposed, because now your new break even is at $268.50. So this is kind of how the covered calls work. You can limit your downside risk because you can lower your break even, and you're kind of receiving income. And again, you can repeat this in 60 days. Say Tesla is still at $290, you can do the exact same thing. You're going to make 7.4% again, and you can just keep repeating this process until your covered calls execute. So this may take say 4 months or 5 months, 6 months, however long it takes. It doesn't really matter. Each say 60 days you're going to receive roughly $2,000 for these shares. So if you take it out in 4 months, cool, you would have made about 15% from the call options. And again, if it was to have fallen, you would have been a bit less risk exposed. So that is how covered calls work, how you use them, and how to estimate your profit potential using them. Hope you enjoyed the video. If you did and you want to watch another video from me, you may enjoy this one or this one.